Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors third quarter 2016 performance updates. I will be providing a brief third quarter performance overview of the iSectors models and conclude with a research brief on the markets. This call shall last about 10 minutes. This presentation will be recorded and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon and it will take you to a link to access the recording. The Post-MPT allocations underperformed their benchmarks in the third quarter. Both Post-MPT allocations were negatively impacted by interest rate sensitive securities, including bonds, utilities, and gold shares. Both strategies were helped, bond utilities and gold shares. Both strategies were helped by energy and technology stock allocations. Post-MPT growth has shifted away from interest rate sensitive allocations towards non-cyclical stocks. Over one half of the allocation is now in energy and utility stocks. The chart on slide 3 presents the price movement of both the energy sector in black and the broad market in red since the July 2014 energy sector high. As you can see from the chart, the recent increase in energy stocks still leaves the sector well behind the market over the last 2 years. If energy inventories continue to decline, demand continues to increase, and OPEC agrees to a production cap, there is room for strong performance from the energy sector. The iSectors post-MPT allocations continue to outpace other ETF strategies. We are pleased that growth is ranked 8 among all 213 ETF strategies for 10-year performance in the Morningstar ETF Managed Portfolio database. We expect post-MPT growth and moderate to continue their reputations as premier allocation strategies utilized by investment advisors. JP Morgan created this slide that presents the intra-year declines for the S&P 500 since 1980 in red dots. Thus, the largest market drop during the year 1980 was 17%, and so far this year, it has been 11%. And it is interesting that the median decline in this 37-year period has been 11%. In other words, stocks have had a 10% plus correction in more years than not during this period. There has been a 20% plus bear market in about 20% of the years. Slide 5 is the same slide as the previous one with the annual returns added. Even though most years have had a correction, 75% of the years have had positive returns. It is interesting to note that 25% of the time, a correction has been paired with a double-digit annual return, as in 2012, for instance. What this slide indicates is that although stocks will increase in price over time, your clients will have to live with corrections, even bear markets, most years. They need a strategy that is built on a notion that downside risk needs to be minimized. This is the objective of the post-MPT allocations. If you haven't already, please consider adding potential downside protection with post-MPT growth and/or moderate in your client portfolios. It is now easier than ever to own post-MPT growth with the launch of the post-MPT growth ETF on NASDAQ in August. Under the symbol PMPT, that's Papa Mike Papa Tango, the ETF's portfolio mirrors that of the post-MPT growth separate accounts. Go to www.isectorsetfs.com for more information. The endowment and liquid alternatives strategies posted attractive returns in a quarter. Specialized equity and timber funds were strong performers. As the chart on slide 6 shows, in black, stocks that were recently brought to market as initial public offerings were in demand throughout the quarter. The chart also plots in red the volatile price trend of one of our commodity funds. The overabundance of supply for most commodities and the prospect for rising interest rates have hurt this sector recently. Both allocations are broadly diversified and will continue to take advantage of the secularly bullish commodity market we are in. Also, it should be noted that the liquid alternatives allocation has outperformed the hedge fund over the past 5 years. Given the advantage of the allocation over hedge funds, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.4%, liquid alternatives should be considered for diversification in case equity returns ease. The global allocations turned in mixed results for the quarter. Global equities outperformed domestic equities, but they both fell behind the S&P 500. The global equity allocation benefited from emerging market holdings, while funds emphasizing dividend stocks detracted from performance for both allocations. The global fixed income allocation was positively impacted by U.S. mortgage-backed and international corporate weightings in the quarter. The allocation was hurt by international sovereign holdings. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most large cap core strategies. In fact, the domestic equity allocation is ranked 6th out of all 510 ETF strategies in the Morningstar database for 5 years performance. The inflation protection and precious metals allocations continued their rises during the quarter. Over the past 12 months, inflation protection is up over 14%, and precious metals rose 22.5%. As you can see in the chart on slide 8, palladium was the star performer amongst precious metals for the quarter due to strong Chinese auto sales, the primary industrial user of the metal. Timber and Treasury inflation protection securities helped inflation protection allocations results. Commodity holdings negatively impacted the inflation protection allocation. We continue to believe that a 10 to 20% allocation to precious metals, inflation protection, or liquid alternatives will be worthwhile given our view that the next 5 years in the equity markets will not be as profitable as the last 5 years. As the chart on slide 9 indicates, capital preservation has earned over 2% on an annualized basis over the past 5 years. The yield is attractive with a short duration while maintaining investment grade quality on average. Capital preservation rose during the recent quarter due to short mortgage and high yield holdings. Finally, the tactical global balance allocation underperformed its 60% stocks, 40% bond benchmark in the third quarter. As represented by the chart on slide 10, emerging market equities was the leading performer for the allocation in the quarter. Rising interest rates hurt gold and real estate holdings. Although it has recently sold its bond and real estate holdings, tactical global balance continues to be fully invested in all the other major domestic and emerging market asset classes. All 15 of the iSector allocations have at least 5 years of live performance. In this slide, we want to highlight the Morningstar star ratings for some of our most attractive strategies. I want to especially highlight the large blend portfolios. If you're looking for a good combination of equity strategies, a 50% allocation to domestic equity, which is always invested in a dividend-leaning portfolio, and 50% allocation to the tactical post-MPT growth strategy could smooth market returns while keeping clients invested in stocks. Historically, this combination has had a lower standard deviation than each of them individually. Please contact us if you wish to receive additional information. If you've been following our post-MPT strategies, you know that we believe that we are in a low growth environment. Slide 12 presents the long-term thought behind our view as presented by J.P. Morgan. Unlike in the past, our working age population is growing at a slow rate. This is due to the decrease in skilled immigration, baby boomers leaving the workforce, and the end of growth due to women entering the workforce. At the same time, productivity has declined as businesses have not invested in new equipment and technology at the rate they did so in the past. Without changes in tax policy, immigration policy, and fiscal spending, our economy will continue to grow at the 1.5% annual rate we have seen in the first 3 quarters of this year. Obviously, this is not good for equities and bolsters our case for adding post-MPT, liquid alternatives, and inflation protection asset classes in client portfolios. Please carefully inspect the disclosure page. I would like to conclude for thanking everyone for attending our webinar this afternoon. If there's anything we could do to assist you with your wealth management or 401k asset allocation needs, please let us know. If you have any questions, you can email me at chuck.self@iSectors.com or reach me on Twitter at @Chuck_iSectors. We can be reached directly at area code 800-869-5184. Again, thank you, and hope you all have a wonderful holiday season.